So there's a clear distinction you can make. Can be an example of low cost currency, and for high cost, obviously rupee. The moment you go for MIBOR itself is around 650, right? You'll get MIBOR plus spread or some fixed rate loans you are going to get in the market. So your rupee is an example, dollar is an example of high cost currency. Now, one basic thought process, rather one basic concept that we have to highlight here, which is very important to understand the loan hedging and choice of currency, is that by default, low cost currencies, right, versus high cost currencies, if you want to choose between them, low cost does not mean low all-in cost in rupee. It does not meaning borrowing in yen by paying only 0.4% instead of borrowing in dollars by paying 4.5%, right? It does not mean that when you convert that into rupees, because you are a rupee company, if you want to convert everything into rupee borrowing cost, a low cost borrowing currency does not translate into a low all-in cost in rupee terms. What do you mean by that? It means, I'll give an example, then this is the important concept to understand. What I'm trying to say is, if you have, this is my, let's say JPY rate, right? Now you're borrowing here. Now, if I want to convert this JPY loan into rupee loan, right? This is INR. I am going to pay this as my hedge cost. Market will charge me this hedge cost, the forward premium. So this JPY to rupee versus same thing. Let me just probably write it here. Yeah. So let's do it again. This is JPY, right? Let's say 0%. This is INR, right? The difference is the cost, forward premium cost. Now, the dollar is here. This is 4% dollar, 4.5% or 4%. And rupee is here, again INR, right? So you see, this is dollar USD. The forward premium is this much. So what it means is, even if you borrow in low interest rate currency, the moment you want to convert that as a fully hedged INR loan, the amount of forward premium that you're going to pay is nothing but the interest rate differential. So you're back to the same INR cost. Actually, it's more, but I'll tell you why. At least it's back to the same INR cost. Meaning the hedge cost will adjust accordingly. So low interest rate currencies don't have a benefit compared to high interest rate currencies when it comes to completely converting that loan, foreign currency loan, into rupee. That's the fundamental point that we have to drill down, so that people should not be under the misconception that because JPY interest rates are zero, we will have a much lower financing cost. Yes, you will have a much lower financing cost, provided you don't hedge that into rupee, keep it open, and take on the FX risk, because it's in JPY, your repayment will be in JPY. And as long as JPY does not depreciate with respect to rupee, you're fine. You're actually fine. Correct? It does not appreciate with respect to rupee by more than 7%, which is the interest rate differential, you're fine. So you have to take on FX risk. But if the moment you don't want to take on FX risk and want to completely hedge it, there's no point in actually going for low cost currencies, because the mathematics will turn out